and welcome to Property Question Time. I'm Bryony Billson and this is the show where you get the chance to have your questions answered by our resident property experts. So let's see who we have in the hot seat today. First of all, a warm welcome to Suchit Punnose, founder and CEO of Red Ribbon. We also have Satyen Lakhani from OffMarket Investment. And last but no means least, Paul Mahoney from Nova Financial Limited. Thank you for joining us today, gentlemen. And we have a lot of questions to get through today. We have our viewers sending in some very detailed questions to do with property and investment. And our first one goes to you, Suchit. I'm trying to buy a property from an NRI. The location is in Bangalore and the amount agreed upon was 60 lakhs. After digging through Google for procedures to buy a property from NRI, I came to understand that I have to do tax deductions at source before I make the payment. And when I inform this to the seller wants to back off, saying that he wants to do the whole transaction in black. I also understand that I have to give him from 16A when I deduct TDS and give him the balance amount. I'm really not sure how to proceed here. Any guidance would be highly appreciated. We really like the apartment and do not want to miss it.
Right, there's quite a few points in there. Well, I think to simplify the matter, from what I understand there is a non-resident Indian here in the UK buying from another NRI and the property is in Bangalore. I think the very simple approach to it is that when you are transacting or selling a property, you have to follow local tax guidelines. If there is a tax deduction at source, that's what TDS stands for, then that is something you have to comply with. So there's no two ways about going about this. If the seller is asking for it, refers to black, which is cash, it's illegal, you cannot do it. Therefore, you need to simply follow the route of finding another property. Bangalore is a city with a lot of options, so it wouldn't be hard to find good quality properties. And with anything, it's all about common sense. If you have a seller who is being difficult, then you do want to walk away from that property.
Fantastic, thank you. A brilliant response to what seemed like a confusing question, but you clarified that really well for us. Thank you. Does anybody else have any advice in that area, or perhaps particularly in terms of, say, trusting your instincts with when to walk away from? It sounded quite like a pushy situation here. Getting the right advice. How can you trust that you're being advised in the correct way?
The only thing I'd say, Indian property isn't my area of expertise, but the only thing I'd say is when you see somebody trying to do something that is clearly not right, then, as you say, it gives you a bit of a bad feeling about it, so it wouldn't be something that I'd be interested in getting involved in.
I think perhaps when you have a lot of experience in investing or with property, it's very obvious to you when something is perhaps not going in the right direction or doesn't seem quite right. But from what I understand with some of our viewers is that when it's a first-time investment or you're quite new to the industry, it is actually quite difficult to gauge, well, is that just how people operate in this field, or is there something not right here? So, do you think it all comes back down to just doing more research?
Absolutely. I think the clue is when you're buying offshore, follow the process where you're buying from.
Right, yeah.
And research that, exactly.
And I think we cannot discount that there's clearly emotions playing in there. They fall in love with the property and overlooking the seller and what his intentions are, which, as many experts have said in previous shows as well, it's all about making sure that you keep the emotions out of this.
My next question goes to you, Satyen. I'm trying to understand the process of buying off-plan properties. We have a house currently, but may be under offer in the coming weeks. The house we are interested in is a new build and would require a 25% deposit with an exchange of contracts in 28 days, although it's not even built yet. But we don't have these kinds of funds in liquid assets, but we do have them in the equity of our house. How would we be able to exchange contracts, say in 28 days, if our house was under offer? They say they're just trying to understand the process and if it can be done.
Yeah, not exactly easy from what you've read out there. The buyer clearly has a motive. They have a property that they want to sell and they've got money in that property. But from what you've mentioned is they need to realise that money from that property to proceed with the purchase of an off-plan property. I think it's fair to say that most off-plan properties require a deposit to be put down, which will reserve the unit, and then followed by a quick exchange, usually in 28 days, and in this instance with a sum, which is quite a large sum of 25%. But that is, by way of conveyance, what the process is. So it's not something that's untoward. But again, you need to seek clarity to make sure you're in a position you can do that. And clearly in this case, the funds are not ready. The funds are in the property that they want to sell. So how long is that process going to take? They need to seek advice there from an agent that they may want to give the property to sell, and how, again, timing is key here. If it takes longer, there's a chance they would lose that property, and whatever reservation fee they put down, it would go with it as well. So again, seek the right advice from a third party that are going to help you sell that property and how quickly that property is saleable. Then you need to speak to the developer to see how long you will really have, and again, utilising your own solicitor to see if they can seek extension on that 28-day. Usually the developer is going to say, no, we've done this with all our sales, it's 28 days or nothing. So again, do you want to go through that pressure that you might lose your reservation fee if your money or if your property doesn't sell in time? So there's a lot of things to find out first before you say, yes, I'm going for this. And I think we've all alluded to the same thing. They've got to keep the emotions out of this. Don't go head first, falling in love with the property you want to buy. Then you make the wrong decisions. You let emotions get in the way. But clearly in this instance, they've got to do their research on their current property first to make sure how quickly can we sell it. What price do we need to sell it at to make it a quick sale as well? And again, figures come into this. How much are they looking to lose to gain from that property so they can go ahead and purchase the new one? So there's a lot of ifs and buts there.
Amazing answer, thank you.
Yeah.
Yeah, sorry. No, brilliant, fantastic answer, and I think it's well worth keeping in mind that perhaps buying off plan and in this style it isn't appropriate for everyone, or isn't the right situation for everyone to do. So thank you for that. We are going to have to move on from that question, but really fantastic answer, because I can see there are a number of permutations to this situation. So thank you for clarifying some of that for us. My next question comes to you, Paul. And this person has inherited £250,000. They want to invest it wisely, quite rightly, and they're considering shares or property, or maybe both. But they want it to be a long-term investment that works for them. What would you advise?
Well, good question. Firstly, it's important for me to say that my answer is very general in nature and not specific to them. So they shouldn't act upon it. They should definitely seek personal advice before investing that money. Certainly my take, though, when it comes to investing for the long term, and I suppose the reason for my preference for property as an investment asset class, even though it's not necessarily considered that in the greater market, is with property, you can invest over the long term with relatively high loan-to-value ratios, low interest rates, and often with no ability for a mortgage lender to recall your mortgage. So the main differential, I'd say, between shares and property is the ability for leverage or a mortgage. Overall, the returns tend to be relatively similar. You know, you're looking at kind of, 4 to 6, 7% returns per annum from both kind of shares and property as a cash purchase. So to get as a cash purchase, they work relatively similarly, although I would say property is a bit more stable. It's the ability to take mortgages on property that really makes it quite a strong investment. The fact that you can, for example, invest a £25,000 deposit into a £100,000 property, and just by achieving relatively average returns on that property of 4 or 5% yields and 4 or 5% growth, you can be achieving a 20 or 30% return on your cash. Now, often when I speak to people about that 20 or 30% return, that seems really, really high, but it's on the cash that's invested, and it's because you're multiplying your returns through the use of the mortgage. So that's one thing to consider. The fact that you can do that with property and you can't necessarily do that with shares. You can borrow with shares, but the interest rates are high, the loan to values are low, and you also run the risk of what's called margin loans, which means if the value of your shares fall, you either need to sell or apply more cash, often at the worst possible time. So certainly my take in general would be that property as a larger part of the portfolio is more suitable for a broader range of people. But of course it's worth having diversification as well. So perhaps a little bit into each. But as I say, seek personal advice, because that will be very much based upon the specifics of your situation, whereas this is quite a general question.
Yeah, brilliant advice. Thank you, Paul.
I think just to add to
Yeah, of
that point,
course.
in terms of an investment opportunity or decision making, I think it's also about diversification. Paul's very right in the fact that when you're leveraging on a property, your return on equity is higher. Equally, one needs to appreciate that anything to do with property is illiquid. Now, whilst the viewer wants a long-term investment, you never know when you need access to cash. And why people tend to traditionally go for shares is for the liquidity. So long-term is very good. That's the right approach. But you want to have a balance between return and liquidity.
Brilliant. Yeah.
One more comment on that.
Yeah, please do.
And again, I do agree with you, but a little bit of healthy debate here. I think sometimes people are their own worst enemy when it comes to investing, and liquidity causes yourself to be your own worst enemy. Now, what I mean by that is a lot of people don't really have the stomach for shares. I don't mean that in a negative way. I mean, you see on your share platform that the value of your shares have fallen by 40%. The automatic reaction is to sell. Get out. Properties don't have a ticker on the letterbox. They don't tell you how much the value's fallen by. So sometimes liquidity can be a positive thing when you're investing illiquidity can be a positive thing when you're investing for the long term, because you protect yourself from yourself.
Of course, yeah. Thank you. Do you have anything else to add?
I think there's a distinction between the two. Again, shares that are a bit more short term in terms of how quickly you can manage, how quickly you can purchase, whereas the property, it may be a longer term process. So again, it's down to the individual and their appetite of how much time they can devote to one or the other. And with shares, clearly, as we've seen and has been mentioned, you need to give it the time it deserves, that you need to be on your ball, on your game, to see your platforms, how quickly they move up and down. Whereas property is far more indirect in that regard. So I think, where's your time, who's going to give you the advice and expertise, and that will dictate which route to go and how much to spread your risk on.
Thank you. I know it's an area a lot of people are interested in, how to invest with shares or properties, and I think the three of you have covered that really well, so thank you very much. Right, we are going to take a quick break now, but stay with us because we'll be back with our property experts to hear more of their advice to some of your questions and maybe one or two golden nuggets. We'll see you then. Welcome back to Property Question Time with me, Bryony Billson, and my expert panellists today are Suchit Punnose, Satyen Lakhani and Paul Mahoney. So Suchit, you have a golden nugget for us today.
Yes, indeed. Often people ask me the question as to the fact that, okay, why invest in India? And of course the answer is there's a great opportunity for both income and capital growth. But how does one go in and do it without the hassles of owning a property, identifying a property or going to India and buying it? And my answer is to look for an India-centric property fund. So you're putting your monies in, it's in direct ownership. You don't get the excitement of having a title in your name. But if you went through a property fund which invests in India, then you get the similar returns, but with experts managing your money on the ground in India. So that's a brilliant way to go into India and property investment in India.
Thank you for your golden nugget. Next question goes to you, Satyen. I was looking at an off-plan flat due for completion in about a year. The unnegotiated value is $326,000 and they want £5,000 deposit and then the reserve of 30% within 28 days of placing the reserve. So that's £98,000, a huge amount. My partner and I currently have $20,000 in cash and $40,000 in the value of our flat before selling and solicitor's fees. Otherwise, no debts except a student loan, and they say they really like the plans for this flat and they think with some negotiation it would be a good buy, but they just can't see a way to fund it and asked what can they do?
Wow. Okay. It'd be foolish of me to give you advice on this because they'd have to seek advice from a financial advisor really, and someone who would get to know their personal situation far better than just on a conversation that we have today. So they need to iron out what their current position is in terms of selling that property, how much money is in that property that they can release, What's the best way to release that? Do they need to sell, or can they refinance to get the money out? And then are they in a position they can utilise that money quickly enough to substantiate the purchase or their next purchase? And again, other factors come into this. Will they need finance to complete their next purchase? There's a lot of things that they need to go through in terms of process. And again, by seeking the advice of someone like Paul, who probably be the expert to say, look, this is the best route for you. This is where we can get you finance from this lender very quickly, or this is what they would require. And then take it step by step, and then see if the decision is still there and the motivation is still there to purchase the new property. Because those are large figures that they're working with, and you don't want it to fall flat on your face at the last hurdle then. So you need to make sure that everything's worked out properly before you approach the developer. Because in this instances, developers are very keen to take your deposit money straight away and make you feel, yeah, no problem, no problem. But you may not get that deposit money back, because it usually is non-refundable if you don't, work through and get your finances right in the first instance.
Thank you.
Unless I misunderstood the question, it didn't seem as like they had enough money for the deposit anyway, which might be the first stumbling block.
Yeah, and I think it kind of tied back to the point you were making there as well about are they really sure that they've got the money to go through with this? And perhaps one of the areas we have been touching upon is the mixture of emotion versus logic and strategy, because as they mentioned, they really love the floor plans, and perhaps they've been thinking a little bit more with their heart and not with their head, which I think you picked up on here.
I have the figure of 93,000 required for the deposit, and they have 20 plus 40, being 60. So unless the developer's willing to take 60, there's not even much point in considering any further, I suppose. That would be their first thing to consider. Did I get that wrong?
You're spot on there. It was 98,000 actually.
98 needed, they've got 60. So unless the developer's willing to take a much lesser deposit, then that's the first hurdle that could rule it all out. And Satyen's actually right, the finance is the other thing. What you definitely don't want to do is be buying off plan without the confidence that you can then get the mortgage at the end of the day, because legally the developer can take your deposit and take that £60,000 and resell your unit. Often they won't. Often they'll be a little bit more flexible in that, because it's not good business to be taking people's money and giving yourself a bad name like that. But that they are more than entitled to if they want to.
Thank you. It seems to me as well that with a lot of people are very keen to go with off plan, but the risks to me seem quite high, particularly like you were saying about losing your deposit. I don't know whether I've misunderstood that.
The risk can be high, but the rewards can be high as well.
Okay.
By buying off plan, often you can get a better price, or you can get a better unit within the building. I suppose one of the benefits of off plan is you can see the whole building, all the layouts, all the pricing. You can position yourself in the best possible way from the start, which of course, when it comes to property, if you've got the better property than everyone else, then there's going to be more demand, both from a rental and a resale perspective. So there's definitely benefits, but there's definitely more considerations as well.
Also, I think when you buy off plan, you are technically locking your price in today for something that's going to be built in the future. So there are massive rewards there, capital gains. The area might be growing in value as well because of new employment being there, or new infrastructure such as a new station or new roadways through there. So there's loads of things to look at. And I think also, and this probably alludes to my golden nugget later in the show, but it's apt now, that when you buy off plan, you don't tend to just buy off of one of the portals, property portals, Rightmove, etc. There usually is a company that works with that developer. There are the sales agents, and they are by way of a off-plan investment company. And they have a sales department there that want to sell you a property, but they don't want to waste their time either. So they'll assess you to make sure, are you a good candidate for that property? And once they tell you what your position is, then you need to go and seek advice from a financial advisor or from a lawyer to make sure that, okay, this is what they said. Am I in the right category for this? So you're not going in blind. There are people there that will support you or tell you, no, this isn't the right thing to do. Because no one wants to do a lot of work and then see no reward for that.
Of course, yeah.
Particularly sales companies. So they will put you in the right direction to make sure, are you a good candidate for that property? And again, as we've all said, emotion. You don't want to be emotionally attached, it's too early. But if you buy in the right places and you do your work properly, yes, you'll see some great rewards for buying off plan. Hence why developers want that forward selling purchase scenario, because they know that if they get your money now, they can move on to another project. And from your benefit is that you lock that price in today for something that's going to complete in a year's time or maybe even longer. So you can see that if it's in an area where the value keeps going up and up, you will win in terms of your reward, in terms of capital gain. But to get to that end position, you have to be in a position to start the process. And that requires you to be cash rich in a way, to at least put the reservation fee down and your deposit to make sure you're in a position to exchange contracts. So it's quite long-winded, but there is a process there, and there are people that will help you through that process.
Thank you. Brilliant advice. So get their finances sorted, take the advice, and then sort that head-heart situation out. Yeah. Excellent. We are going to have to move on, but thank you for your answer to that question. Really helpful and lots to consider there. Paul, my next question goes to you. Our viewer has asked, I'm looking to invest in a property in London, but the boroughs seem to move up and down and in some and remain steady in others. Are there any safe boroughs to invest in, or perhaps you'd recommend somewhere else?
Yeah, I think the key word there is investment, in that when it comes to London in the current market, it's actually quite difficult to justify. And it's difficult to justify because of a range of changes that have occurred recently with regard, and again, I won't go into the specifics, but we've had Section 24, we've had a 3% stamp duty premium, and more recently we've had 2 changes from the PRA regarding mortgage serviceability and also portfolio landlords. So what that's resulted in is becoming more and more difficult to borrow a reasonable amount of money on London properties. There are ways around it, but generally you're putting in a lot of money, so far as a deposit, to a property that is kind of just breaking even. So from the perspective of sort of running the numbers and comparing that to your other options, for example, the average property price in London now is just shy of £550,000. So, you know, generally you're having to put in around £200,000 to that purchase as a buy-to-let for something that won't really give you much cash flow at all. With that same amount of money, you could buy 4 properties in the Midlands or the Northwest that will generate significant positive cash flow. So I suppose for this particular person, it's going to be determined by why they're investing, you know, what it is they want to achieve. If it is solely just an investment, and this seems to be a running theme, things we're talking about today, so far as being unemotional, being commercially minded, understanding their goals and therefore putting in place a strategy to achieve those goals. Because, you know, remembering property investment isn't about property. It's about making money, you know. So just investing in a London borough because you live in London doesn't make London a good investment. You know, it might seem familiar, and it might seem, you know, I read a stat recently that said that 9 out of 10 people invest within 5 miles of their own home, which kind of makes sense because you get the area, but just because it's within 5 miles of your own home doesn't make it a good place to invest. So I suppose my take on that would be expand your horizons a bit. Don't just focus on London boroughs for the sake of it. If that's the only place that you're familiar, then certainly do your research on what might make the most sense, because, you know, the point in the question is exactly right. Between London boroughs, they're all very, very different, and offer very different things. But don't just assume that because it's London, it's the best place to invest. I'd say historically that's kind of been the attitude, but that attitude is shifting. Okay,
brilliant. Thank you. So kind of cast your net a bit wider, maybe be a little bit more bold with the areas you'd consider, and one borough is not necessarily
bold, just flexible. Okay. You know, not take the blinkers off a little bit.
Yeah, great advice.
I think if the viewer is insistent on London, one of the strategies many property developers and property investors follow is the Crossrail strategy. So with the upcoming Crossrail, there are new stations coming up, and the common sense approach is to buy a property within 500 metres of a new Crossrail station. So that's a common sense route to follow. A lot of experienced property investors are following that strategy at the moment, and that means then it's agnostic to which borough you're in. You follow a rail track and you buy near a station. That would be yet another way. Again, as Paul said, take the emotion out. You have to have a strategy, even if you're investing in London.
That's a really helpful, practical tip. Thank you for that. And I am actually going to come straight back to you for the next question. We're going to have to move on from that one there. The question is to you, Suchit, is rental return from overseas property taxable in India?
Yes, like any income within India is treated as and is taxable. So rental yield is treated as income and therefore is taxable locally in India. But you can offset that against your personal tax here in the UK, so you're not taxed twice. So yeah, there is double taxation treaties within UK and India. So if you're paying £100 as tax in India, you can write that off in the tax here in the UK.
Sadly, that's all we've got time for today, but please send us your questions to info@propertytelevision.tv, or you can go to our website, property-tv.co.uk, where you can have the chance to have your questions answered by our resident property experts. We'll see you next time.